Off. The fall of the Great Bull. Coupled with an extended bull market, the enactment of ERSA had the effect of coating modern portfolio theory (MPT) in the eyes of the majority of investors and investment managers. In a nutshell, MPT emphasizes that risk is an inherent part of a higher reward and that investors can construct portfolios in order to optimize risk for expected returns. For fiduciaries, the concept of controlled risk through diverse asset allocation is certainly appealing. When markets are behaving as they were for nearly 2 bullish decades, the return, risk, and correlation assumptions used to generate asset allocation analysis tend to sync relatively well with the market activity. A trend is predictable as long as it continues. In this environment, modern portfolio theory became the comfortable thread that held the financial market's complex patchwork quilt together. Within the model, asset managers that performed well on a relative basis within a single easily identifiable style could consistently raise assets. Once they stepped away from their advertised style, however, their opportunities became limited. An unfortunate result of this phenomenon was that this narrow, restrictive environment tended to limit the growth of asset managers' skill base. It's difficult to understand how talented, competitive individuals allowed themselves to remain locked into one specific management style for so long, especially when that style had clearly fallen out of favor. I saw managers literally go out of business rather than change their investment approach. As the Great Bull began to show signs of strain and the equity markets began to behave with far less certainty, no longer trending up, it became apparent that the relativistic MPT-driven business model embraced by traditional asset managers, one in which money was managed on a relative basis, track records were marketed based on relative performance, and performance was measured in relative terms, was plagued by significant weakness. Alexander M. Inshin of Union Bank of Switzerland estimated that total global equity peaked at a little over 31 trillion. Oh, hang on one second. I gotta answer all the 570 calls because it could be my son. All right. Alexander M. Inshin of UBS estimated that total global equity peaked at a little over 31 trillion at the top of the bull market, falling to approximately 18 trillion at the 2002 low, a decline of approximately 42%. As during the 1974 period, the investment community reluctantly began to embrace change in order to cope with the divide that opened between the objectives and traditional money managers and the needs of their clients. One of the prime cases for this divide was that MPT depends on reasonable assumptions for each asset class. Implicitly, this requires a very long-term view. Investors must plan on holding their investments for a long time in order to reap the desired rewards. Unfortunately, when markets failed to cooperate toward the end of the bull market, it became evident that most individuals and institutions have a vastly different perspective of what long-term means, especially when short-term performance is on the line. During times of market stress, the correlations between asset classes often fall apart, which often results in unexpected poor performance. The rise of absolute return. There appears to be a dearth of insight into how investors respond when the shorter time frame delivers significantly different results than was advertised and expected for the longer term. But there is no lack of evidence that the long-term minded investors, when confronted with unexpectedly poor short-term results, tend to liquidate their holdings at precisely the wrong time. As the markets became more volatile and uncertain, traders and investors who had broken free from the relativistic herd embracing an absolute return philosophy continued to produce positive returns at a time when the majority of traditional asset managers were posting consistently negative returns along with the market. Because absolute return investors measure themselves against their risk-free rate rather than relative to a market index, they must be more flexible and nimble. They must have the ability to employ a much broader arsenal of investment strategies in order to achieve their goal of delivering consistently positive performance. This group can employ all styles across all capitalizations. They can also short securities, which creates even more opportunities and enables portfolio managers to exploit both overpriced as well as underpriced securities. The end of the Great Bull served as a catalyst for a much more adventurous and entrepreneurial environment. In today's atmosphere, it's harder for the traditional money management firms to hold on to talented traders and portfolio managers, as the financial rewards for stepping out solo can be extremely large for truly capable individuals. The firms that want to survive and prosper in the absolute return blue must adapt and find new incentives for attracting and retaining such innovators. An article in a leading UK newspaper, The Observer, reported that Dillon Red Capital Management, the new hedge fund unit established by UBS in 2005, embarked $1 billion in bonuses for its first 3 years in business to ensure that it continued to attract and retain successful traders. When the article appeared there were only about 120 employees in that unit, which would work out on average to about $3 million per employee. It's no wonder that we continue to see a steady exodus of portfolio managers from the traditional asset management firms towards those organizations that offer more challenging opportunities in a new world of absolute return. Succeeding in an absolute return market environment. Following a strong rise or bubble, markets historically remain within bracketing ranges for many years. As most equity markets peaked in early 2000, we are in the 5th year of a bear market at the time of this writing. Although the term bear in this context is misleading, it is more useful to think of the current conditions as indicative of a consolidating trading or bracketed market. The high to low range of a consolidating market offers excellent opportunities for traders who are adaptable enough to trade them. John Maludin in Bullseye Investing, Targeting Real Investors, a smoke and mirrors market, Hoboken, New Jersey, John Wiley and Sons, states that the shortest bear on record is 8 years, with the average being 16 years. During these periods, it seems as if the market's actions are guided by some shrewd NFL offensive coordinator. Just when it looks like the market is going long, it pulls up short, jukes left, and rolls right, leaving a pile of stunned investors in its wake. Consolidating markets are tricky. Just when you think you've got them figured out, you end up on the wrong way on a big move, and you feel like you've been betrayed by everything you know. Many traders begin to think of the market as a cunning adversary who tries to foil their best laid plans, or perhaps a tempting siren bent on luring them to the bottom of their bank accounts. In the long-term bull market or in a relative return market, you can succeed by simply staying fully invested and matching the market's steady rise. In a bear or consolidating market, such as the one we're in now, savvy traders seek to identify and profit from mispriced securities, both on the long as well as the short side of the market. Achieving absolute returns, returns that consistently exceed the risk-free rate, regardless of market direction, requires skill, self-knowledge, and understanding of market and investor behavior and trading maturity. The point here is that relative and absolute approaches exist at opposite ends of the spectrum, and bracketing market conditions reward absolute return investors, those individuals who are concerned with the value of their portfolios at every point in time, not just at some predetermined maturation. See figure 1.3. If history continues to repeat itself, as it has for the past 5 years, then the 20-year bull run will fade farther into the past and subsequently and be substantially different approach to the market understanding will be required to consistently succeed. It is worth noting here in Mind Over Markets, the first collaboration between these authors was written in the middle of the Great Bull Market, when most investors had already climbed aboard the relative return train. The theories and practices prescribed in the book are as applicable today as they were then. There is still unexpected volatility in bull markets, and Mind Over Markets provided a detailed treatise on taking advantage of such volatility. Since the Great Bull, market mechanics and human behavior have not changed, although much around them has. With the proliferation of hedge funds, for example, there is more short-term momentum trading, which means the markets tend to move faster and go further once a movement has started. But bull or bear or bracket, markets always conform to the fundamental dictates of time, price, and volume. We'll revisit some of these principles set forth in Mind Over Markets within the new context of this book. Pure, unbiased information. As you have already surmised, the volatility of consolidating markets is generally far greater than that experienced in bull markets. This increased volatility provides both risk and opportunity. Traders who are ruled by their emotions or led by nearsighted analysis will continue to chase upward swings and bail out on downward swings, which results in temporarily mispriced securities as well as the financial destruction suffered by those who get whipsawed. This progression between bracket extremes provides prime opportunities to take advantage of fleeting discrepancies between price and value. Markets and Profile is in large part dedicated to explicitating this phenomenon in the clear light of market-generated information, not the deluge of hype and conflicting information that serves only to fuel the emotional panic behind most market movement. Those individuals who have the trifecta of market experience, self-understanding, and skill can avoid the classic panic in, panic out whipsaw and take advantage of those who don't. Absolute return investing is a zero-sum game, with a few highly skilled professionals taking from those who run, generally terrified with the pack. Who are those few? They are the investment professionals with the experience to take long-term view while capitalizing on short-term inequities in market structure. Those who understand their own vulnerabilities so they don't fall prey to the slings and arrows of doubt, anger, and fear. Those who have the discipline to focus solely on relevant market-generated information while the data explosion ranges around them. Market-generated information is the pure, unbiased information that comes directly from the market itself. Structuring and interpreting this information is an excellent way to get a truly objective opinion about what's driving the market movement, and it's based solely upon real order flow. Market-generated information represents a composite of all available information at any given moment. from macro to micro. And by organizing this information using the CBOT's market profile, you can monitor market structure in real time context, which enables you to recognize paradigm shifts in equilibrium. When there is symmetry to market structure, as shown in Figure 1.4, which manifests itself in a traditional bell-shaped curve, then there is generally a balance between good opportunities and bad. When the market profile becomes asymmetric, as shown in Figure 1.5, then there is a lack of balance, which results in opportunities to distinguish favorable and unfavorable investment opportunities. Structuring and reading market generated information via the CBOT's market profile is about identifying opportunities where risk is considerably less than potential reward. Asymmetric opportunities are often caused by irrational human behavior, such as the herd instinct that pushes price away from value. We'll delve more deeply into using the market profile tool and behavioral finance, once referred to as neuroeconomics, in later chapters. The point is that having a reliable, objective information source becomes more important every day. Markets continue to exhibit overwhelming, ever-increasing complexity, driven by growth, diversity, globalization, technological advances, and increasing numbers of participants, and almost limitless outside factors that result in constant change. The remainder of this book is about how you can better understand and interpret the most objective source of information, the market itself. People change markets, markets change people. Change is the beating heart of this book. Markets and Profile addresses the nature of change as it relates to the markets and the market's participants of every type and time frame, from macro to micro, from large institutions to investors who hold positions for decades, and traders who roll with the market's daily facilitations. Everything in this book is equally applicable to the individual traders, money management organizations, the proprietary trading units of the major financial organizations, and all the newly formed alternative investment shops. Second. Hello? Oh shit, I've been reading this whole fucking time. God damn it. Where were we at? I'll start. Oh, yeah. Oh well. I just fucking blew it. Oh well. Where were we at? Let's just start here in chapter 2. I don't know where I stopped or where I was muted from. Um, alright. In chapter 1, we discuss the central role change plays for all market participants. We suggested that people change markets and markets change people. Let us now turn our attention to information, the byproduct of change. The you evidence that change is, and as they say, the only constant. Information has no power until someone acts on it. There are also many responses. There are as many responses to any given piece of information as there are humans who receive it. We all find ourselves somewhere on the long continuum between leader and follower in every endeavor. To illustrate the importance of this concept, consider what would have happened if you were to simultaneously share a perfect investment idea with 5 different people. One of those 5 might act immediately without requiring further evidence, while each of the remaining 4 would act in successively later time periods, waiting to see proof that the idea was in fact generating profits. The diffusion model, made popular by author Malcolm Gladwell in The Tipping Point, would label each of these individuals as innovators, early adopters, early majority, late majority, or laggards. These 5 archetypes can help us better understand the way the various time frames interactions influence the market's auction process. We'll discuss the interplay at length in a later chapter, but first let's explore 2 predominant types of information that affect the market or affect the behavior of all investors: fundamental and market generated information. Fundamental information. Fundamental information includes a broad array of different types, from eccentric, like cutoff waves and S curves, to basic demographic data and big picture business cycle research. Fundamental information can also provide insight into expansion of price earnings multiples during secular bull market cycles, as well as the compression of price earnings during secular bear markets. This kind of information reveals that good earnings don't necessarily lead to higher stock prices. Some of the strongest market advances have occurred during periods of relatively poor earnings growth. Then, of course, there is fundamental information on sectors, industries, and individual companies that show earnings, sales, margins, growth rates, and the list goes on. To make matters more complex, there have been numerous studies that reveal the fundamental information must be viewed in the right context to have any relevance. For example, a 5% yield on the benchmark 10-year Treasury note is viewed from one perspective if the yield has fallen from 7%, but viewed from a totally different perspective if the rate has just climbed to 5% after having been as low as 3.5%. It's all about context. Let's take a real-world example that illuminates the importance of context in interpreting information. A few years after the markets peaked in early 2000, the economy showed signs of reduced inflation and slower growth for several months running, which caused the experts to begin talking about recession, or perhaps worse, there was constant references to Japan, which had recently suffered just such a depression. All right, so working. When the market began to show signs of inflation in the late 2004 and early 2005, it was generally considered to be good news, as the moderate inflation indicated that we were not, after all, likely to slip into a recession. Then, in the late 2005, bonds again rallied on economic news that suggested inflation was well contained and that the real returns were in focus. It's all about context. A fish looks pretty silly flopping around on the dock, but that same motion in the context of water results in graceful, powerful movement. Yeah, I can hear it. But it's not playing on the YouTube. I don't know why it's playing. I don't know how to stop it either. I turned it off for you guys, though. I have to just power through it. I don't know how to turn it off. In addition to the larger economic environment, at any given movement, which dictates whether inflation is considered good or bad news, there is also personal context to be considered. That is, information may be viewed differently depending upon an investor's time frame, such as a scalper, day trader, short-term trader, intermediate-term trader, and long-term investor. A company's reported earnings may be positive when viewed from the long-term perspective, but short-term traders might take the same news to be negative, due to the dashed hopes for even higher numbers. Countless articles have been written that support the value of fundamental research, but articles have also been published that suggest that the same research is so flawed and biased that it actually has a negative effect on performance. Because of this common bifurcation, it is important to distinguish between the accuracy and thoughtful research and the ability of that research to predict future securities prices. A piece of fundamental analysis may be absolutely correct. An analyst may have accurately analyzed a company's earnings, but the market may respond to that information in a completely unexpected way. Of course, that doesn't mean the analysis is bad. Firms that produce fundamental research often produce that research for non-investment purposes, or from the perspective of a different time frame, or for institutional clients who use the information to generate new business. They're not soothsayers, however, despite what many might wish to believe. Nobel Prize laureate Daniel Kahneman sums up the context this way. People don't assign the correct weights to information, and they assign too much weight to information, especially if they have collected it themselves. Due to the information glut available to everyone who trades, it is nearly impossible to view all incoming information in the correct context, especially considering the short-term focus that seems to be pervasive today. As a result, information can be used to make just about any point or justify any position one wishes to make. As much publicized example of the inherent challenges of understanding fundamental information is commonly known as Greenspan conundrum. In 2005, the former chairman of the Federal Reserve, Alan Greenspan, failed to comprehend why fixed income securities didn't react as expected to the multiple rate hikes he initiated during the previous year. Of course, there was no shortage of experts deriding him for this oversight after the fact. During this same period, the fixed income trading results of many of the largest and most respected financial service firms were negatively affected by the same conundrum. The experts expected the fixed income market to behave a certain predictable way and positioned their books accordingly, but it didn't. One of the primary goals of this book is to explain how market-generated information can help you navigate through conundrums like the one that flummoxed Mr. Greenspan and many of his counterparties, their contemporaries. Really hard to power through this music. All right. Rational or irrational? Kahneman and Tversky demonstrated that investors are not only irrational, but they are predictably irrational. But is irrationality really the right term for this behavior? Imagine you're at the track. You've gone over all the odds, read the expert opinions, and completed your own analysis, which of course is influenced by a myriad of factors, like the fact that one of the horses shares the name with your alma mater, and the other happens to have placed in the last 3 races. You make your wager before the race starts and settle in to watch the horses run. What if we change the rules and let you place your bet after the race is already underway? A totally different side of human psychology would be revealed. Once again, all the information must be placed within its proper context. How will your decision be affected if your horse you had planned to bet on is currently in the lead? What if the horse is losing momentum around the second turn? How will your betting habits be affected by the real-time information? Oh, what's happening here? We should expect, considering a general understanding of human nature, that the larger the horse's lead, the more individuals will place bets on that horse to win, and that bets on that horse in the back of the pack will evaporate. When you extrapolate this behavior in the context of financial markets, is it really so irrational? When you think about it, betting on a clear winner is a pretty rational decision in the immediacy of the moment. This phenomenon is commonly known as momentum investing, which is often the primary force behind short-term movement. And just as the payoff odds decrease in a betting pool as more money is placed upon a particular entry, the payoff odds decrease for late momentum investors as the market explores price extremes. The racetrack vignette was meant to illustrate the ways in which markets can change people's actions. But there is one important difference between the track and financial markets. The horse race has a specified beginning and end, whereas financial market movements are never ending. In such continuously evolving environment, the human behavior described above can provide opportunities for both momentum and value investors. Value investors on the long side of the market seek securities that are undervalued relative to certain criteria, which may mean low price earning multiples, low price to book value, large amounts of cash. We'll explore the opportunities at length later in this book. Irrational or not, market behavior is the sum of total of the actions of all the individual participants and disciplines and timeframes. It is influenced by the confluence of innumerable information sources and the whims of human nature. There are very few individual and institutional investors that aren't affected by this fantastically complex convergence, and it is extremely difficult to gain an advantage in today's markets, dominated as they are by short-term orientation. Market-generated information. The premise of this book is that market-generated information, when combined with fundamental information, can provide an elusive advantage. Market-generated information is information gained from observing the actual flow of orders within the market presented in the market's present tense context. Making sense of this source of information begins by recognizing that markets are constantly moving from low to high and high to low. This two-way auction process enables all market participants to express their opinions, no matter how those opinions were obtained with real money. The auctions effectively establish a fair price where business can be conducted at any given time. This expression of the market's collective will result in constant flow of objective market-generated information. In order to manage this information, as we mentioned in the preface of this book, we employ the Chicago Board of Exchange trader support tool called Market Profile. Market Profile is not a trading system, nor is it predictive. Market Profile simply allows you to observe the structure of the market as it unfolds, enabling a more accurate interpretation of which time frame is in control of the market movement. This concept of time frame control will be a recurring theme throughout Markets and Profile. The market, as we have said, is the manifestation of all possible influencers all news sources, all global and political news, and all market participants. As the market's continuous auction unfolds, a market profile enables us to experience a composite of all available information and opinions because it is solely based on real order flow. Market generated information, when properly organized and understood, can greatly demystify the endless complexity of the market. Such data can uncover vital information about what is driving change by providing clues that help unravel the strength and weaknesses of market momentum. To establish significance of objective means of interpreting market activity, let's revisit the potential pitfalls inherent in relying solely on fundamental information. Suppose that an analyst performs methodical, well-informed research on a company and comes to the conclusion that the company is well positioned for strong growth in the next quarter. But what this fundamental information may not reveal is whether the price of that company's stock has already moved to reflect that fact. Or perhaps the industry within the company within which the company operates is on the verge of collapse, and nobody is interested in the sector as a whole. The positive report may be meaningless unless viewed in the proper context. Think of the numerous factors that must all line up to make fundamental information relevant. Even with the slightest miscalculation can result over time in serious investment consequences. Of course, investors and money managers must be aware of fundamental indicators, but wouldn't it make sense to employ an objective means of ensuring that those indicators are actually resulting in the expected market activity? Let's say you just bought shares of a good company that had an underpriced stock. You bought value, but the price has remained basically flat for an extended period of time. This is not uncommon, and is why many investors wait to invest until price momentum validates their buy decision. By using the market profile tool, one can often discover confirming information, positive or negative, in the market structure before it is reflected in a significant price movement. Securing good trade location or being able to exit a bad trade earlier is the advantage we were discussing earlier. Before we provide a mechanical description of the market profile's construction, let us first define trading, which in the context of this discussion is no different than investing. Trading is the anticipation, timing, and placement of orders to capitalize on change, no matter how short or long term the underlying investments. The auctions. Auctions are made up of three fundamental elements: price, time, and volume. Price is simply the auction's means of advertising opportunity. Time regulates each opportunity, and volume measures the degree of success of each auction. As with any auction, there are goods for sale, bidders tempting to buy, and sellers trying to sell. While price is the mechanism used to fairly distribute goods among participants, the skew of volume and price enables us to see how willing or unwilling the participants were to either acquire or give up their holdings. Some will be willing to relinquish their goods at fair price, while others will only enter the auction process if they perceive price to be away from fair value. As in all successful financial endeavors, it quickly becomes clear that not all prices are equal, and that identifying fair value consensus is pivotal in understanding the underlying forces at work in any given market. Warren Buffett has been saying this for years. A market profile, by its very nature, helps identify price in relationship to value. Fair value. Fair value is defined as the price levels that are attracting the greatest volume of trade. As you will see as we progress, fair value has different relevance for different time frames. Markets are generally fair only in the day time frame, and what is considered fair in the day time frame is often unfair from a longer point of view. As the market's two-way auction process unfolds, there is an ongoing search for information between buyers and sellers, much the same way that manufacturers and distributors continually seek information about each other to maximize profits. Once either fair value or once either party perceives an advantage, they will attempt to move price away from fair value in order to increase profit. This attempted divergence is constant, and the market profile records the resulting auctions via a histogram or distribution curve. Historically, scientists have employed the histogram to organize data so that it can be observed and better understood. As Peter Bernstein establishes in the book Against the Gods, the remarkable story of risk, the normal curve or bell curve enabling the evolution of human civilization, by providing a means of determining statistically the potential risk and reward intrinsic in any venture, such as opening a trade route to the West Indies. A market profile histogram is created through the ongoing development of the market's information discovery system. Its continuous two-way auction process that advertises price in order to distribute volumes of fair and competitive in a fair and competitive manner. The volume or bidding activity determines whether or not divergences from value can be sustained. On one day, sellers are discouraged by prices below value, and buyers are discouraged by prices above value. While both sides have essentially established a value area, any movement away from the value will serve to shut off the flow of auction activity until price returns to equilibrium. This is commonly known as reversion to the mean. On another day, the same market may find that divergences from value, higher or lower prices, actually attract more volume rather than shutting it off, which forces participants to reassess their idea of value. Investors who trade via reversion to the mean will be unable to sustain profitability when the divergences from value are successful. We demonstrate how knowledge profile experienced traders can perceive both situations while markets are unfolding by observing the profile's graphic depiction of the relationship between time, price, and volume, the true fundamentals of market behavior. In the discussion above, we referred to the day time frame. However, the same theory applies to all time frames. While we have not yet described these time frames, we have referred to them as scalpers, day-time frames, short-term time frames, intermediate-term time frames, and long-term time frame. Market profile fundamentals, the author's note. The following section contains a very brief discussion of market profile construction. For a detailed discussion on the market's profile's construction and mechanics, please refer to Mind Over Markets and other texts mentioned throughout this book and in the references. The construction of a histogram requires a constant and a variable. Market profile treats time as a constant, placing it on the horizontal axis with price, the variable, arranged on the vertical axis. You can construct a market profile graphic using any time interval in any liquid financial market. For demonstration purposes, we have chosen to represent the day time frame auction, which we have broken down into 30-minute intervals, each of which is assigned a letter. As the market passes through various price points, the letter designation, the current time period, appears besides those prices. Over time, the letters, known as time price opportunities or TPOs, accumulate, creating a graphic view of the day's distribution curve. Once again, this concept is the same for any time frames mentioned above. Here's figure 2.1 at. Figure 2.1 shows a relatively balanced market forming a fairly typical bell curve that it is an accumulation of prices, greater volume at the center of the distribution, and diminishing accumulation, less volume at the extremes. As you become familiar with the way the market profile evolves over time, you can begin to visualize the completion of the histogram and how to best trade it. Prior to the day's completion, to effectively trade the market represented in Figure 2.1, a reversion to the mean strategy would be most appropriate, and it's clear that there is no consensus in the market regarding value, highlighted below the bracket. Figure 2.2 shows the same profile, only we have kept each time interval distinct so that you can see where the market moved during each period. In addition to the day time frame distributions, experienced investors also view profiles that cover longer time frames in order to maintain a clear long-term perspective of market activity. A longer-term histogram reveals whether the intermediate auction is occurring within the context of a bracketing or trending market. A bracketing market, also referred to as a balancing, range-bound trading, or sideways market, consists of several days with overlapping ranges. Trending markets show much less tendency to overlap as price and value areas consistently trend up or down. We will expand on the relationship between price and value as we move forward. One of the most important yet challenging market assessments that investors wrestle with is determining whether a market is bracketing or trending. To make this determination even more of a challenge, it is also true that brackets and trends are largely time frame dependent. A trend to a scalper is of no consequence to the long-term investor. An upward trend to a day time frame trader may simply be a series of 30-minute time periods with higher highs and higher lows. However, for the intermediate term trader, this activity is considered non-trending, and the activity remains well contained within the middle quadrants of the intermediate term bracket or trading range. A trend for an intermediate term trader may be a move between the extremes of a larger trading range with no longer term trend as the market remains balanced from long-term perspective. Context, context, context. The value area mentioned previously, a fundamental element of the market's profile, is determined as the range of prices that includes 70% of all TPOs in a profile. The prices that saw the most activity is witnessed by the greatest accumulation of individual time period letters. The value area is determined by starting with the price that resulted in the greatest volume, the longest horizontal line, then summing the volume according at the two prices directly above the high volume price and comparing it to the sum of the two prices below. The dual price total with the highest volume becomes part of the value area. This process then continues until 70% of the volume is accounted for. Figure 2.3 illustrates this process. Notice that the value area represents approximately one standard deviation. The distinction enables you to distinguish price from value, the most fundamental principle of investing. When price occurs within the value area, price and value are considered to be the same. When price occurs outside the value area, price is considered to be away from value. Regardless of your time frame, as price moves away from the value area, there will be either an acceptance of the move witnessed by TPOs accumulating at the new level, which effectively changes the shape of the profile and shifts the value area, or rejection, in which case price will return to the value area with little change in the volume distribution. Trends occur when price movements result in value area migration. Bracketing markets are revealed when price movements continually revert to the constant or to the consistent value area containing price within a well-defined parameters that can last for months. Figure 2.4, see page 26, shows the S&P 500 contract profile from November 21st, 2005 through December 29th, 2005. A 27-day intermediate term trading bracket that ranged from 1257.5 to 1284.70. During this period, the market completed 5 legs that traversed from low to high, high to low, low to high, high to low, low to high, which was followed by a partial break and rally, and finally a high to low break that led to a downward spike on the final trading day of 2005. Inspection of the profile in figure 2.4 reveals that the longest horizontal line, which represents the highest volume, occurred in the lower portion of the profile. Recalling how we calculated the value area by summing the volume both above and below the high volume area, referred to as the point of control, you will see that the POC was moving lower over the course of these 27 days, which signifies that the value area was being forced lower. Without the multi-dimensional view, time, price, and volume, what is really occurring in this market might have been mistaken by hype. The experts, especially the CNN analysis, were all reporting high odds for a Santa Claus rally, defined as the trading period between Christmas and New Year's. You couldn't turn on the television without seeing some pundit announcing the inevitable rally, but if such a rally were really intimate, then the point of control should have been rising, not falling. Volume, as revealed through the market profile, was indicating a consensus that something altogether different than what the experts were predicting. All right, that's where we're going to have to stop today. I got to go pick up my kids. But we almost got to an hour. Yeah, had to cut a little bit short. But yeah. Other than that, those of you guys on YouTube, you guys have a wonderful day. Join us back on Monday. We'll do some more learning by reading, which is something that I encourage everybody to do because reading makes you smarter. Who doesn't want to be smarter? But other than that, you guys have a wonderful day, and I will catch you guys later.